So we have to do three topics. One is inventory, second is revenue recognition as in accounting for sales and bad debts and allowances related to debtors, and third is cash flow statement. Everything else is done actually, right? So we will broadly devote one day per topic. Cash flow statement, the basics are done. Inventory, we have already devoted half a day earlier on FIFO, LIFO and all. So let's look at inventories today. Inventory are products being held prior to sale, of course. And why is inventory valuation important? If you remember when we were talking about some frauds and all, we spoke about multiple things. One of the things that we spoke of when discussing LIFO, FIFO, etc. was how you value impacts both the cost of goods sold and the value of inventory. How you value impacts both the cost of goods sold and the value of inventory. The cost of goods sold enters the profit and loss account, while the value of inventory enters the balance sheet. Do you remember what we said last time? So just to summarize what we said last time, I'll just write it down here. Do you remember we said jug 1, we spoke of, we solved a problem also, but to remind you of the basic concept, we spoke about jug 1 which was bought at 10 rupees, and then we spoke of jug 2 which was bought at 20 rupees, right? And then we said that FIFO and we spoke of this jug, right? This jug. We said we have bought two jugs. One jug at 10 rupees, the second jug at 20 rupees. How will we value it under FIFO? And how many jugs did we sell out of two? We sold one jug. So under FIFO, this 10 rupees, first in, first out was sold. First in, first out. So the cost of goods sold is 10 rupees. But this 20 is still with us. First in, first out. So the last one is still with us, while inventory is 20. Under LIFO, the case is reverse. Last in, first out. So this 20 rupees is our cost of goods sold, and inventory is 10 rupees, this one, last in, first out. Under weighted average, we take the average 15, right? One is sold, one is with us. So inventory is 15 and cost of goods sold is also 15. When the cost of goods sold is low, 10 versus 20 versus 15, right? Then the profit is high. And when the inventory is 20, so we have more assets in the balance sheet. So the balance sheet is strong. For LIFO, what's the scene? For LIFO we have cost of goods sold is 20. So the profit is low. You see that? Because the cost is high, so the profit is low. And asset is valued at 10 rupee, here it was 20, so the balance sheet here is weak. Balance sheet is weak. Right? And for weighted average, these are equal. So it's somewhere in the middle. You see that? It's a middle situation, middle. Both in terms of cost of goods sold. So middle situation. So profit is also in the middle, right? Are you getting it? This is for everything is in the middle, right? So everything is like profit is also in the middle. Balance sheet is also neither strong nor weak, etc. This is the essence of what we had discussed, and this is why the valuation of inventory matters. Why? Because how you value inventory affects cost of goods sold, so that will impact your profit and loss account, and then it also affects your balance sheet, right? So what is the essence of inventory valuation? We will see it in greater detail, but the essence of inventory valuation is we will value inventory at lower of cost or market. So cost or market price, whichever is less. And why do we do that? Accountants are conservative people. Accountants are conservative people. I bought this jug at, let us say, I just come back to one thing. I have this glass now, yeah? I bought this glass at 10 rupees. The market price of the glass falls to 8 rupees. Should I value my glass inventory at 10 rupees or 8 rupees? 8 rupees. Why? Because inventory should be valued at lower of cost or market price. Lower of cost or market price. And if the market price goes up to 12, cost is 10, should I value it at 12 or 8? 10, right? So that's the point, that we don't value it at a higher or lower market price, we value it at cost, right? If the market price is high. So overall we value it at lower of cost or market. And what was the conservative principle of accounting, do you remember?
We should always make the provisions for the losses, not for the profit.
Yes, yes. So, yeah, more or less, right? Yeah. Who said recognize all losses? Yeah.
When we receive it, recognize cost, then it incur.
Conservative principle basically was we will, all of you are partially correct, but the essence of what was the essence of conservative principle? Recognize all expenses and losses as soon as possible, but when it comes to incomes and gains, we will recognize them only when we are 100% sure कि हाँ हो रहा है, right? So when it comes to expenses and losses, we will recognize it as soon as possible, but when it comes to incomes and gains, we will recognize when we are 100% certain, right? And so this clearly is a conservative way कि the moment the market price is low, it is a potential loss, so we recognize it immediately. But when the market price is high, this is not an actual gain, this is an unrealized gain. Do you see that? When the market price is high, this is not an actual gain, this is an unrealized gain, and therefore an unrealized gain should not be accounted for. But a potential loss from 10 to 8 should still be accounted for, but a potential gain is not to be accounted. Okay. Yeah. So what is the market value? We will see there is a very mild difference between US GAAP and IFRS, which we will see in one of the later slides today. But the essence of valuation of inventory is following the conservative principle, we will value it at lower of cost or market. Next. Yeah. So the other aspect, we have already looked at the valuation methods, which was FIFO, LIFO, weighted average. By the way, the fourth was specific identification method, right? You remember that specific identification method? So under specific identification method, what we would have done? The jug that was actually sold would be specifically identified that okay, the selling price is say 21 rupees. So if the jug that was sold was of the first jug, then we will say the selling price was 21, the cost was 10, and therefore the profit is 11, 21 minus 10. But if the second jug was sold, specifically we will identify, then we will say selling price is 21, cost is 20, profit is 1. What? So that's the essence. Yeah. So perpetual, so there are two methods of inventory systems or two inventory systems. One is a perpetual inventory system, second is a periodic inventory system. For all of you who have done your BCom or BBA, in India we almost always teach the periodic inventory system. So that's what you have learnt in your BCom or BBA, right? So the name itself suggests what the inventory system is. When we say periodic system, it means inventory is being ascertained periodically, the closing balance. The cost of goods sold is being ascertained periodically at the end of the accounting period, which can be 1 month, 3 months, 6 months, 9 months, 12 months, whatever. In a perpetual system, as the name indicates, inventory is being monitored on a perpetual basis. So at any point of time, you would know what is the closing balance of inventory and what is the cost of goods sold, right? So coming back, so what is a perpetual system? First we will do some theory and then we will do a written example where you actually get to learn something. So it's a continuous record of inventories on hand and cost of goods sold. How does it help the manager? Because if you get a continuous, if you know right now that my cost of goods sold is 100, then you can determine the selling price. I know my cost of goods sold is 100 and if I have to sell at 110, ठीक है निकालो यार. Similarly, so it helps to control the inventory levels, it helps to prepare the interim financial statements, and it helps in pricing and ordering, right? Because if I know right now my cost of goods sold is 100, then if I get a bulk order saying can you sell everything to me at 105, I'll say yeah, ठीक है जाने दो, I can always buy more. इसको तो let me sell the entire unit 5 rupees of profit मिल ही रहा है, right? Are you getting what I am saying? So it will help in the pricing decision. Next, under a perpetual system, the count is always known, always at that point in time. As in, at any point in time, you know what is the count of inventory. So identifying, counting and assigning a specific cost to all items in inventories. It helps remove damaged and obsolete goods from inventory. It helps in identifying shrinkage, the loss of inventory from theft. This you will know when you do a physical count. The accounting records will anyway show the count, but when an auditor comes, let us say you are showing you have 100 glasses as per your inventory records, you have 100 glasses lying with you. But when you actually do a year-end check, when the auditor comes and sees, you realize it is 99 glasses. The एक glass कहाँ गया? Right? So it may be one glass was broken and thrown away. It may be one glass was stolen. Somebody quietly took one glass away. So various possibilities exist. It can be theft, breakage or some other form of loss. Next. So what's the perpetual inventory system? What we have done in transaction analysis, we have almost always followed the perpetual inventory system. What you have learnt in BCom and BBA, most of you would have learnt the periodic inventory system. ठीक है ना? So on days 1 and 2, when we spoke of inventory, this is what we did. When we purchase, we increase the inventory asset goes up and increase accounts payable, liability goes up. I am assuming credit purchase, right? If you otherwise, if it was cash purchase, then inventory goes up and cash goes down, right? Similarly, at the point of sale, asset, either cash or account receivable goes up, and sales revenue increases your stockholders' equity. This is what we learnt on days 1 and 2. And at the same time, the moment we sell, we sold goods at 100 rupees, but the actual cost to us was how much? 80 rupees. So here we will show 100 rupees and immediately we will account for the cost of goods sold of 80 rupees. So that will reflect the fact that cost of the net effect is 100 minus 80 is actually reflecting the profit on sale. And here we had anyways inventory, so inventory worth costing 80 rupees is sold, so we have to reduce it from the value of the inventory. And so we have done this methodology in days 1, 2 and in subsequent transaction analysis, and so that is the methodology of the perpetual inventory system, right? So then we have periodic, next. So what are the journal entries for perpetual inventory system? When inventory is purchased, we saw that inventory account is debited, accounts payable is credited or cash is credited. When inventory is sold, account receivable is debited, sales revenue is credited, and immediately that was for 100 rupees and for the cost was 80 rupees, cost of goods sold 80, inventory 80, right? So this was our perpetual system of accounting. Next. Periodic inventory is a bit different from the perpetual inventory. Periodic inventory computes cost of goods sold and an updated inventory balance. So under periodic inventory, what we do is we compute cost of goods sold and inventory not on every transaction to transaction basis. We do it based on accounting period. वहाँ पर in the previous case we sold 1 lakh, we recorded the cost of goods sold 80,000, net profit 20. Here we are not doing that. Here you are following what you have learnt in your BCom and BBA. What did you learn in your BCom and BBA? In your BCom and BBA you were told opening stock plus purchase minus closing stock is your cost of goods sold, right? Opening stock plus purchase minus closing stock is your cost of goods sold. If you don't have a BCom and BBA background and if it is not making intuitive sense, then let me explain it in terms of units, then you understand it much better. I'll give you a few examples. We started a business. What is the opening stock? Zero. We have just started the business. कुछ भी नहीं है. So opening stock is 0. During the year, think of it not in terms of amount, think of it in terms of units. It will make intuitive sense. We started a business, opening stock is 0. We purchased 10 units during the year. If 1 unit is still lying with us, how many units did we sell?
9.
Right? Alternatively, if we sold 9 units, how many units are lying with us? 1. You get it? So it's like that. Beginning inventory को एक बार भूल जाओ. You purchased 10 units. If 1 unit is lying with you, that means you sold 9 units. Alternatively, you purchased 10 units. If you sold 9 units, then 1 unit is lying with you. So as long as you have one of the two, you can calculate the other. Are you getting it? You bought 10 units. There was no opening stock. You sold 9. So 1 is lying with you. Alternative, if you are told you bought 10 units and only 1 is lying with you, that means 9 were sold. So are you seeing it? Forget this part. Purchase minus ending inventory is cost of goods sold. Go to the next year. At the beginning of the year, the closing stock of 31st of March is the opening stock of 1st of April. The closing stock of 31st of March is the opening stock of 1st of April. The ending inventory of previous period is the opening stock of the current period, right? So next year, what is your opening stock? 1 unit. Again you bought 10 units. So how many were available for sale? 1 of previous and 10 of this year. So 1 plus 10, 11 is available for sale. How many, let us say how many did you sell? Let us say you sold all 11 and you closed the business. So opening stock of 1 plus purchase of 10, 11. You close the business after selling everything, so ending inventory is 0. Is how many did you sell? Opening stock of 1, 10 you purchased, you sold how many? 11. Are you all clear? So this is making it clear that why opening stock plus purchase minus closing stock is your cost of goods sold. If you see it in, so what I just explained in terms of units, if you think about it in terms of cost, what if the cost is 1 rupee per unit? Then unit and cost is same, 1 rupee per unit. Got it? आप कुछ भी change करते रहो. So unit and cost are the same and therefore it will be. You have understood it? Perfect. Next. So what are the journal entries to be passed under the periodic system? So this is what you are used to. All our BCom and BBA friends are used to this since your BCom 11-12 days, right? So when you purchase something, what do? You say purchase account is debited and either cash or accounts payable is credited. When you sell something, what do? Accounts receivable or cash, depending on cash or credit sale, is debited and sales revenue is credited. And then what do you do at the end of the accounting period? At the end of the accounting period, look at this. What we just saw in the previous slide was opening stock plus purchase minus closing stock is cost of goods sold. So opening stock plus purchase minus closing stock represents the cost of goods sold. Are you seeing it? So cost of goods sold debit, purchase and inventory opening stock is credited. Finally, closing stock is debited and cost of goods sold is credited. Are you seeing that? So, and why is it making sense? The same thing. Opening stock plus purchase minus closing stock represents the net cost of goods sold. Right? Next. So what is sum of goods, cost of goods available for sale? That makes intuitive sense. Opening inventory plus purchases during the period. How much was available for sale during the second year? 1 unit of opening stock, 10 units purchased during the year. So you could have sold 11 units. Whether you sold 1, 2, 3, 4, 5 is a separate matter. The cost of goods available for sale was 1 unit of opening stock and 10 units of purchases. Next. So what is the theoretical difference between periodic versus perpetual? Count occurs in periodic. You don't count it daily. Count occurs at the end of the accounting period to determine the amount of inventory and for calculating the cost of goods sold, right? But in perpetual system, count occurs during the year. And why are we doing count during the year? To check accuracy of record. Because our record is saying I have 100 glasses. What if I only have 99 or 98? So accounting record is still correct, but that difference of 1 or 2 is normal. For example, if you are having some liquid, say तेल था, थोड़ा सा when you are selling the oil, थोड़ा सा spill हो गया, right? When you might have seen when you are selling milk, let us say open, थोड़ा सा spill हो जाता है, right? So even though you bought 100 liters, you are only able to sell 99 liters because everyone says yeah थोड़ा तो और दो, right? So here you are checking accuracy of record on a regular basis. Here you are doing everything at the end of the accounting period. So if the accounting period is 1 year, तब तो last year end में ही मालूम पड़ेगा. But here you know every time. This is my inventory, this is my cost of goods sold, and it will help in your pricing decision. There you will not know on an instant basis, and that's the reason it's called perpetual, because it's a continuous system, and that's the reason it's called periodic, because it's ad hoc at the end of the period. Right? Next. Physical inventory count is of course a time consuming process. If there are only 100 glasses, कोई problem नहीं है. Right? If there are only 100 glasses, it will take half an hour to count 100 glasses. But for companies with huge factories, lakhs and lakhs of products, like एक चीज 10,000 types of products, and every product, we are talking of big companies. Then physical inventory checking is a very tedious and a continuous process that takes days and weeks. So this is what physical inventory count is needed to ensure that the value of inventory recorded in books is correct. Next. Yeah, calculate the cost of merchandise acquired. Next. So get ready with your pen and paper. In the next slide we are coming up with a question for you. So what is the cost of merchandise? Invoice price plus inbound transportation charges minus any offsetting discounts. And what are the kind of transportation charges that are paid? So basically the freight charges, which can be, these are called Incoterms. What are they called? Incoterms. FOB is free on board. So free on board till destination. Free on board till destination means the seller will bear the cost. Free on board till shipping point means the buyer will bear the cost, right? That till the point of shipping it is free, but thereafter you have to bear the cost of shipping. And this is in freight inward or inward transportation is an additional cost of the goods acquired, right? Because the transportation cost also has to be considered. In the last 10-15 minutes of the day, we will also look at manufacturing firms, but for the time being let's continue with a trading kind of a firm. Next. So though, have you skipped a slide? I think so. Achha, haan, ye wala. So this is the question. Hello, everyone start solving. Everyone please solve, pen and paper out. So what's the question? The question is this. Opening stock is 100,000, purchase is 990k, purchase return is 80k, and closing stock is 140k. The first line states the question, plus consider that the closing stock is 140k. Yeah? Calculate the cost of goods sold. Everyone calculate. So this line is showing the question, plus I am just adding one more thing called closing stock is 140k. Calculate the cost of goods sold. You have 1 minute. I am giving you all 1 minute. So it's done for all.
Yes.
क्या था? Opening stock 100. Purchase. What is net purchase? Purchase minus purchase return is net purchase. How much? 910 minus ending inventory is 140k. So cost of goods sold is 100 plus 910 minus 140 equal to 870. Everyone clear on that? Very simple, right? So now let us draw the ledger accounts for this case, for under the perpetual case. Go to the next slide. So draw the ledger accounts under the perpetual. You already know the journal entries, right? So journal entries are known. Draw the ledger account. हो गया? Done? ले बताओ, बहुत टाइम नहीं है, जल्दी करो, फटाफट करो. बड़ा सिंपल है, राइट? इट्स वेरी सिंपल. सो inventory, what was the opening balance? 100, purchase was 990, 80 was purchase return, and this closing balance is 140, so the cost of goods sold is 870, which goes there, right? Everyone is done, right? And what is the, let us assume that when we did a physical check of inventory, as per our records, inventory is how much? As per our records, inventory is 140. Na? Cost of goods sold is 870. Closing stock is how much? 140, right? But when we checked it physically, physical check, we realized only 135k of inventory is there. So there is actually a loss. As per records, it was 140k, but as per physical check, 135k. How do you account for this 5k? A loss has to be recorded, right? And what we will call it inventory shrinkage cost or inventory shrinkage expense, whatever, 5, and inventory account is credited. Why? Because the cost of inventory will go down from 140 to 135, so inventory account is credited. This is simple, right? Next. Now let us look at the difference between the perpetual versus the periodic record. This is very important. This slide is very important because it is showing the difference between perpetual versus periodic record. Under perpetual, when we buy, what did we say? Inventory account is debited, accounts payable is credited, right? What are we doing under periodic? We don't say inventory account debited, we say purchase account debited and accounts payable credited. When we have any returns, we say, we just reverse this. Account payable is debited, inventory is credited, though in case B, case A case B is the reversal of case A. So entry is also the reverse. Here we will say account payable was credited, so we debit it. We don't debit credit purchase, we create a new account called purchase returns and allowances, right? We can technically, so it's called as purchase return, right? As goods are sold, the moment we sell goods, cost of goods sold is recorded and inventory account is credited, and here there is no entry. Do you see that? That sale for inventory. When we sell good, cash to sales or account receivable to sales will anyways be recorded. When we sell goods, cash account debited to sales or account receivable debited to sales will always be recorded. That goes without saying, right? The question is, what do we do for inventory under the perpetual system? The moment we sell, I was saying the selling price is 100 and cost price is 80. AR, account receivable to sales 100 or cash to sales 100 will anyways be recorded. But under perpetual, immediately a journal entry will be posted, which is taking into account that the inventory balance has gone down by 80 rupees because the cost was 80. So we will say cost of goods sold debited 80 to inventory 80. And in this case, we already know from our calculations and our workings that the cost of goods sold was 870. So in this case, we say cost of goods sold debited 870 to inventory credited 870. But under periodic, there is no entry at this time. Under periodic, the equivalent entry will be passed at the end of the accounting period. Here it's passed instantly. That's the reason it's called as perpetual record. Right now I know what is my cost of goods sold. Right now I know how much inventory I have, right? Think of hundreds of transactions. After every transaction, I would know this is how much inventory I have, this is my cost of goods sold, this is how much profit I am making. Think of it after hundreds of transactions because there is no entry. Now you are clueless. how much is the cost of goods sold, how much is the inventory, right? So that's the reason it's called as a periodic system, that at the end of the accounting period you calculate what is my cost of goods sold, what is my inventory balance. And at the end of the accounting period, as it is like a student who was preparing throughout the year. So he doesn't have to study too much during the exam and then compare that student with yourself, right? Because throughout the semester I didn't study. So now at the end of the accounting period, you have to study a lot, right? So your exams are anyways coming. It was just a gentle reminder. Yeah. So you have understood which category you all fall into, right? Not understood, you know yourself since childhood, right? You all know yourself since childhood. So at the end of the accounting period, we will pass an entry. What is the entry? Cost of goods sold debit. And look at this. This is net purchase. These two jointly represent the net purchase of 910. This is opening inventory. Opening inventory plus net purchase minus closing inventory represents the cost of goods sold. Opening inventory plus net purchase minus closing inventory represents the cost of goods sold. Look at it, cost of goods sold 870 hai. Look at the net impact. How much is the cost of goods sold? 870. Look at the entire thing. 1010 debit, 140 credit, net is how much? 870. What is the figure here? Cost of goods sold is 870. Are you seeing that? So cost of goods sold, at the end it doesn't matter whether you used perpetual or periodic. At the end it does not matter because the record will still be the same, right? But this is the difference in the two methods. And what is the, so everyone please pass the entries immediately, jaldi karo, and then pass the ledger accounts, prepare the ledger accounts, yeah. So under both the systems, pass the journal entry and then prepare the ledger account, and you only have 6 minutes, yeah, for all journal entries and all ledger. So previous ledger accounts you have prepared under perpetual. This is the ledger account under the periodic, right? This is exactly the same. This is exactly the same as what we have already done, right? This is in the form of a slide. There in the last 3 slides I had copy pasted from the book, right? Next. Again this is perpetual system ledger accounts, which we have already seen. Next. Then minor differences in valuation determined by physical count and perpetual record due to clerical error or shrinkage. So it will, then we have to adjust the inventory, and we have already seen the inventory shrinkage as in this case was 5 rupees, right? So what was the entry we passed? Inventory shrinkage 5, debited, inventory account credited 5. Next. Then this is under periodic system. These are the ledger accounts under the periodic system which we have all prepared. Next. Yeah, done. Next. So this is okay. So I have anyways reviewed this at the beginning. We have actually done this part earlier, right? We have already done this part earlier, and I have just reviewed it for you. And I mentioned, by the way, I may have forgotten to mention, so this is the case of inflation, because the first jug was bought at 10 rupees and the second jug was bought at 20 rupees. So this is a case of inflation, right? So under inflation we said FIFO will give a higher profit and balance sheet is strong. LIFO will give a lower profit and balance sheet is weak, and weighted average is somewhere in the middle, right? Because we are taking average. And then specific identification, we have to specifically look at the cost of that thing, right? So this is for the case of inflation, which is rising prices. What if the prices are falling? Then reverse will happen. If the prices are falling, then the reverse case will happen, but that is you have to do yourself. You just solve it yourself and you will see that exactly the reverse case will happen, which you can anyways understand intuitively, right? Next. Acha, skip 7-8 slides, go to slide number 37. Since we have already done LIFO, FIFO, weighted average and specific identification methods, so we will not discuss them anymore. The only thing that we need to discuss is whatever method we choose for inventory valuation, it should be applied consistently over time. Only then the results of year 1 and the results of year 2 and year 3 are comparable. Because if you keep changing the inventory method, then we will not be able to compare the years. Do you see that? And change in inventory method is justifiable if there is a change in market condition. Auditor has to approve your change, and note of change in financial statements required. Note as in, as a result of change in the method of valuation of inventory, as a result of a change in the method of valuation of inventory, this is the impact on profit. This is the impact on profit. Yeah, next. Yeah, so lower of cost or market, we have already discussed briefly why lower of cost or market, right? We have already discussed it briefly, that it represents the conservative principle of accounting. Next. So, yeah, there if you remember when I was discussing lower of cost or market, I mentioned there is a difference between US GAAP and IFRS. I mentioned there is a difference between US GAAP and IFRS. So, under IFRS, we said okay market price, but what is market price? We said lower of cost price or market price. What is market price? What is the definition of market price? Current price. So, but just look at the difference. Selling price or buying price? Have you seen when you go to a share market, trade, they have something called as a bid-ask spread. They have something called as a bid-ask spread. A share costing 100 rupees, if you buy it, you will have to buy at 100.5. If you sell it, you will get 100 minus 0.5. Are you getting the concept? So you will get 99.5. Gold, same thing. Go and buy a gold jewelry. They will say the gold itself is worth 100 rupees, let us say, and the making charge is another 2-3 rupees or 5 rupees. And go try to sell a gold. They will say no, the gold is impure, and even though you are claiming it to be 100, they will first melt it and then say no, there is so much of impurity, and so we will only pay you how much we will pay, 90 rupees. You have seen it, right? So, what is market price under IFRS? The market price under IFRS is the net realizable value, net amount the company expects to receive when it sells. So, when you, for example, this jug, what is the market price of this jug? So, under IFRS, they are saying what is the net realizable value. Let us say the jug can be sold at 100 rupees, but I don't know anyone, right? So, I approach him. यार बेचो, मैं बेच तो दूंगा लेकिन you have to give me 2 rupees for selling. Are you getting it? So, the net realizable value is not 100 rupees, but 100 minus 2, 98 rupees, right? This is what I will get, because वो बोल रहा है मेरे को भी 2 रुपया दो बेचने का, otherwise I will not sell. Why should I sell for you, right? So this is the net market price, but the net realizable value is not 100, it is 98. What under US GAAP? This was the money you will receive when you sell. US GAAP says market price is the current replacement cost. Current replacement cost is cost that you have to incur to buy. Do you see the difference? Here you are saying IFRS में बोल रहे हैं market price is related to sell price. In US GAAP they are saying market price is related to buy price. Net realizable value is the amount that you will receive when you sell. Current replacement cost is how much would it cost a company to do buy. So sell versus buy, that is the, do you see the difference? Do you see the difference? Clear? 100 minus 2 rupees, 98 is the net realizable value. But if I have to buy it, I will buy it either, let us say, at 100 or at 101 including some delivery charge. Are you getting it? वो बोलेगा कि भैया delivery charge दो, तुम्हारे घर पर हम पहुँचाएंगे. We will send it to your home, but please pay the delivery charge of 1 or 2 rupees. Go to Amazon, try to buy something small. They will say for an order of 50 rupees, I will not give you free delivery because my costs are high. For an order of 50 rupees, you have to pay delivery charge also, right? So current replacement cost is cost a company has to pay to buy the inventory item today. Realizable value is what you will get if you sell, what the final amount that you will get if you sell, not the 100, but he will say, I will sell it, give me 2 rupees. So for me the net realizable value is not 100 but 98, right? Next. We will not go because in the other class somebody started questioning on US GAAP versus IFRS. Let me be very honest, this class is a basic class. Yeah, it is not intended to be a class of difference between US GAAP and IFRS. So once in a while I put it on the slide just to, if you are understanding, let's understand. But the intention of the class is not to make you experts in this happens under US GAAP and this happens under IFRS, right? But if it helps you during interview, please feel free to say so, to show that how great you are, right? So when we have a loss on inventory write down, so we will say loss on write down of inventory or cost of goods sold 5 rupees and inventory is credited. This entry, why is this write down happening? Write down is happening because the cost, the market price, the market value has gone below the cost. The only reason when write down can happen, shrinkage was separate. What was shrinkage? Shrinkage was official record saying 140k, actual physical count is showing 135k, 5k was shrinkage, that was separate. Write down, what is write down? Write down is market price has fallen below the cost price, and since you have to value at inventory at lower of cost or market, therefore when the market price falls below the cost, you have to write down the value of inventory. So the cost was 10 rupees, the market price is 8 rupees. Will you show the inventory at 10 rupees or 8 rupees? 8 rupees. What is the current cost? 10 rupees. So you have to credit inventory by 2 rupees so that the value goes down to 8 rupees. So inventory account is credited by 2 rupees and the loss on write down of inventory will reduce, it's a loss, it will reduce your profits by 2 rupees, right? So cost of goods sold goes up or write down of inventory loss goes as a result. Yeah, next. And inventory write down under US GAAP and IFRS are same, except that under IFRS is important. US GAAP is not important for you because unless you are working for a US company, you will never really need to work on US GAAP. But IFRS is important partly because whether you are working in India or whether you are working internationally in Europe or in any other part of the world, IFRS or related regulations are applicable in 100 plus countries. So IFRS is important, and under IFRS, first it went down from 10 to 8. So you wrote it down from 10 to 8. Now the market value has risen from 8 to 12. Market value has risen from 8 to 12. So how should you write up the inventory or by how much? So under US GAAP that's not allowed, right? But under IFRS, if the net realizable value increases subsequently, first it has gone down from 10 to 8, then it increases from 8 to 12. Then you are allowed to reverse, you may, you don't have to, but you are allowed to reverse the write down of 2 rupees and increase inventory value to its original cost of 10 rupees, not of to 12. You are allowed, you may, if you so wish, you may. It's may means it's not mandatory. May means it's not mandatory, but you may write it up to 10 rupees but not 12 rupees. You may write it up to 10 rupees but not 12 rupees. Are you getting the difference? Yeah, next. So, conservative principle I have already explained. So I am not explaining again. So compared with pure cost method, LCM or the lower of cost of market will result in less net income in period of decline in market value of inventory. Less net income because we have done the write down. As a result of the write down, cost is high and profit is low. As a result of the write down, cost is high and the profit is low. Next. So what are the effects of inventory error? I have already explained that the closing stock of 31st of March is the opening stock of 1st of April. So if there is error in the valuation of closing stock of 31st of March, is the same error continued in the 1st of April? Yes or no? Yes or no? Yes. So ending inventory of first period becomes beginning inventory of second year, and therefore there is error affects 2 reporting periods, not just 1. And if ending inventory is understated, that means the cost is overstated. If ending inventory, do you see that when inventory is low, then cost is high, when inventory is high, then cost is low. So they are moving in the opposite direction. That is clear to you, right? So if ending inventory is understated, then the cost of goods sold is overstated, and profit, if cost is high, then profit is low, then the retained earnings is clearly low. You see that? If ending inventory is understated, look at this. When inventory is low, then cost is high. When inventory is high, then cost is low. Do you see that? Exactly the same analogy. If inventory is low, then cost of goods sold is high. If cost of goods sold is high, then the profit is low, and then which means the retained earning is low, and the reverse is also true. Next. Cut-off error. Failure to record a purchase or sale in the correct time period. So auditors routinely review purchase and sale activity at the beginning and end of the year. If you don't record a purchase, let's say you didn't record a purchase by mistake, what will happen? If you did not record a purchase, then the cost of goods sold will go down. Purchase में तो आया ही नहीं. Opening stock plus purchase minus closing stock is cost of goods sold. Opening stock plus purchase minus closing stock is cost of goods sold. If purchase is not taken, you fail to include something in purchase, cost of goods sold will go down, and omitting an item from inventory will have the reverse effect, right? Because the closing stock has gone down. Opening stock plus purchase minus closing stock is cost of goods sold. So the closing stock, when you omit it from the inventory, that means it is omitted from closing stock. So the value of the closing stock is low. So that means the cost of goods sold is high. Next. Yeah, read it. This is very, very simple. Sales less cost of goods sold is gross profit percentage, gross profit divided by sales. Next. gross profits and gross profit percentage vary due to nature of business. This is intuitive. Wholesalers. If you are a wholesaler, what will happen? Hello. Hello. If you are a wholesaler, what will happen? If you are a wholesaler, company that sells in very large quantities to retail companies, let us say I am the person supplying to all, these are all retailers and I am supplying to all of these retailers in Ponta Sahib. So if I buy for 100 and if I have to sell it to them, I will usually sell it at 105 or something at a low margin. Chalo. Because I am selling in bulk. I am not selling one, let us say I buy Colgate toothpaste, let us say. I will supply to all these shopkeepers 100, 100, 100, 100. So when I am selling them 100, will I 100 quantity each. So I will sell them, the cost is also 100, so I will just sell them to 100 ka le lo bhai 105 and sell them to at 105. But when they sell to all the consumers, what will they do? They will say they are selling one toothpaste to you, right? They have bought it from me at 105. They will sell it to you at 120, right? So the wholesalers will have a lower gross profit, but the retailer is the one selling to the final buyer. They will have higher gross profit margin because they are only selling one. I am selling 100, 100, 100 to each of them. For me, it's a bulk sale. Chalo. Why? Because in 100 I have earned, how much did I earn in 100 by selling it to him? 100 into 5. I have earned 500 from one retailer. And how much is he earning from one consumer? 15 rupees. Are you getting that? So for him, it's a headache to sell. For me, sab 100 lo, khatam karo mera kaam. Pharma companies that have high gross profit percentage, because the significant cost of drug R&D is expensed as performed rather than when the drugs are sold. So this is about R&D expense is recognized not at the point of sale, but when you actually did the R&D, right? So as a result, the gross profit is usually high because R&D is a very significant point. If it is not included in cost of goods sold, then if it's sitting below, it is sitting below the gross profit, because in some year the net profit may have been very low. If you have expensed R&D expenses, if you capitalized it and you are doing it gradually, that's a separate issue. But you have expensed it, in some cases it would have impacted the net profit of some years. But the gross profit, because it's below the gross profit line, you see that, right? It is below the gross profit line, therefore will have high gross profit. Next. Yeah, inventory turnover, we already know cost of goods sold upon average inventory. Average inventory is opening stock plus closing stock by 2, and it relates sales levels to inventory, and it's used to compare efficiency of companies in the same industry. And just to remind you, let's go back to our this is 5 minutes ahead. So 4 minutes, okay. So let's go back. I thought I only have 5 minutes left. I have 10 minutes left. So going back to our example on asset turnover, Prathamji, I had 10 crore of assets and you had 10 crore of assets. What did we do? Achha, it's coming up later also. It's coming up later, so अच्छा अभी बोल देते हैं, नहीं बाद में बोलेंगे. It's coming up in one of the slides. I remember when I saw him, so I realized कि हाँ वो inventory turnover का case था. So what is this thing? Inventories with higher gross profit, industries with high gross profit percentage tend to have lower inventory turnover. Why? See, its answer is also hidden here and here. Industries with high gross profit means lower cost of goods sold. अगर ठीक है, high gross profit means lower cost of goods sold. And why should lower cost of goods sold result in low inventory turnover? Look at the formula, cost of goods sold upon average inventory. So if the cost of goods sold is low, then the numerator is low, then inventory turnover is low. So it was answer is hidden here and here. Look at it. If the cost of goods sold is low, then the numerator is low, and therefore if the numerator is low, the ratio is low. As simple as that. Next. Clear, na? Next. Yeah. So this is where Pratham and I, you remember, I had 10 crores of assets and he had 10 crores of assets. But what was I doing? I was having high margin orders, so I sold 50 crores of, my sales was 50 crores, your sale was 70 crores, right? And if only that was looked at, it will look like he is doing a much better job compared to me, right? That was the point. But then we said, okay, fine, maybe his strategy is occupy the market, while my strategy is high end, profitable orders. So on a 50 crore sale, my profit was 5 crore. On a 70 crore sale, your profit was 3.5 crore. You remember that? We all remember that, right? So how is it a strategic issue? Because companies lower prices and decrease gross profit to increase sales. So Pratham, what was he doing? He was lowering the price to get a bigger chunk of the market. So we have to consider, are increased sales because of more consumption or from new customers, or has he taken some unknown customers who were there? Because I was insisting that I need 10% profit and he is saying मैं तो 5% में भी धंधा करूँगा. I am ready to sell at 5% profit, right? So if lower prices increase sales enough, then it is okay. If because of 5% margin, if you can go from 50 crores to 100 crores, let us say, from 70 crores to 100 crores, right? Then he may, or 150 crores or 200 crores, then the overall gross profit that he earns on an absolute basis may be higher than me. And that's the point. But in such a case, competitors may also respond with decreased prices and recover customers. If I see that he is occupying all the market only because by lowering the price, then I am also not stupid. I will also reduce my prices and try to win back those customers. So that's the essence of pricing decision related to inventory and gross profit and cost of goods sold. Next. Auditors use gross profit percent to assess accuracy of records. So auditors also, they are very, very careful when they are assessing the records, because if the gross profit percentage has declined sharply or increased sharply, both can be what's going on. Have you done any accounting irregularity or any accounting jugglery? Do you see that? So auditors will also then look at it with a microscope. Next. And this we have already discussed, that internal control of inventories is important, because we have to look at cameras to monitor, sensors to detect unpaid for products, improved hiring and training practices if you are faced with an inventory shrinkage. Next. We have already discussed LIFO, FIFO and their impact, so I am ignoring. Next. Yeah, this is important. Last slide. So yeah, this is very important. The last two slides and then we are done, right? So when a company manufactures products, the cost of inventory combines the acquisition cost of raw material, wages paid to workers, and allocation of cost of space, energy and equipment used by. So factory rent, factory power, depreciation of machinery, all of these are considered. Next. So raw material, see, till now we need 2-3 more minutes. Abhi khatam nahi hua, we need 3 more minutes. Raw material, items held for sale, we know. All of till now, whatever we discussed was based on raw material. But work in progress valuation, hello, we need 3 more minutes. Includes material cost, labor cost and other direct costs for partially completed items. And finished goods inventory, we will have all of these again. So let's now everyone in the next 3 minutes solve the problem and then you all go. Hi, this is Dr. P. Sanjay and I am a professor at Indian Institute of Management, IIM in Sirmaur. If you like my videos, please feel free to subscribe to my YouTube channel. Thank you.